Welcome to SelfTax YouTube channel. If you're an expat, business owner, or landlord and you're not subscribed yet, this channel is for you. We break down tax rules, deadlines, and changes clearly and simply. Hit subscribe and stay compliant, without the stress. For years, one of the most common tax strategies for UK company directors was simple. Take a small salary, then top it up with dividends. It was efficient, easy to understand, and widely used. But in 2026, that old strategy is under pressure. Dividend tax rates are rising, the dividend allowance is still tiny, and many directors are now asking a serious question. Is the classic salary plus dividends approach still worth it? In this video, I am going to break down what has changed, how the numbers work, and what small business owners need to think about in 2026. Let's start with the facts. From the 6th of April, 2026, the tax rates on dividend income increased. The ordinary rate is now 10.75%. The upper rate is now 35.75%. The additional rate remains 39.35%. At the same time, the dividend allowance is still only £500. That means only the first £500 of dividend income is taxed at 0%. Anything above that is exposed to the new rates. This matters because many directors rely on dividends as part of their personal income strategy. And now, more of that income is being taxed more heavily than before. These 2026 to 2027 dividend rates and the unchanged £500 dividend allowance are set out in official government guidance and Budget 2025 rates documentation. To understand whether the strategy still works, you first need to understand why it became popular. A director of a limited company can usually pay themselves in different ways. The most common are salary through pay and dividends from company profits. Salary is deductible for the company, but it can trigger income tax and national insurance. Dividends are paid from company profits after corporation tax, but they are not subject to employee national insurance in the same way salary is. That difference is exactly why many directors used a small salary and larger dividends. It was often a tax-efficient balance. The dividend tax guidance confirms that dividends are taxed under separate dividend rates, while payroll income falls within ordinary income tax and pay rules. The 2026 to 2027 employer pay guidance remains the official payroll source for salary treatment. The strategy is weaker in 2026 for two main reasons. First, dividend tax rates are higher. That directly reduces the tax advantage of taking more income as dividends. Second, the dividend allowance is still only £500. That allowance used to be much larger in earlier years, but it was cut to £500 from the 6th of April, 2024 and has stayed there. So directors now hit taxable dividends much sooner. This means the old strategy still exists, but the margin of benefit is narrower. For some directors, the difference between salary and dividends is now much smaller than it used to be. Government documents confirm the dividend allowance was reduced to £500 from the 6th of April, 2024 and remains unchanged, while the ordinary and upper dividend rates rise from the 6th of April, 2026. Let's use a simple example. Imagine a director wants to extract income from their company in 2026. One route is to take more salary. The other is to keep salary lower and take dividends. If they take more salary, they may increase income tax and national insurance, but the company may get a deduction for the salary cost. If they take more dividends, the company pays corporation tax first, then the director pays dividend tax personally above the £500 allowance. The result is that the answer is no longer automatic. In 2026, the best route depends more heavily on the company's profits, the director's wider income, and whether the dividends fall into the ordinary, upper, or additional rate band. So the old one-size-fits-all advice is much less reliable than it used to be. the official rates show the key personal tax side of the comparison. Dividends above the £500 allowance are charged at 10.75%, 35.75%, or 39.35% depending on the income band. Dividends have not disappeared. They can still make sense in 2026. They may still be useful when a director wants flexibility in how much to extract from the company. They may still be useful where taking more salary would trigger higher national insurance or unwanted payroll costs. And they may still be useful for directors who are careful about keeping total income within lower tax bands where possible. But the point is this: dividends are no longer the obvious winner just because they are dividends. The numbers now need to be checked properly. This follows directly from the official rise in dividend rates and the low £500 allowance, which together reduce the old dividend advantage. Here are the mistakes that matter most. 1. Assuming last year's pay strategy still works this year without recalculating. 2. Forgetting that only the first £500 of dividends is covered by the dividend allowance. 3. Ignoring the fact that dividends are paid out of post-tax company profits, not pre-tax profits. 4. Assuming dividends are always cheaper than salary. 5. Taking dividends without checking the total personal income position, especially if other income pushes them into the upper or additional dividend rate bands. These mistakes are exactly why many directors are now paying more tax than they expected. Official government material confirms the £500 allowance and the higher 2026 dividend rates, which make stale planning assumptions riskier. If you run a limited company, here are the practical questions you should review in 2026. How much salary are you taking through payroll? How much dividend income are you planning to take? What other income do you already have personally? Where will your dividend income sit within the tax bands? Does your company have sufficient post-tax profits for dividends? And have you checked whether the strategy still works with the new dividend rates? That is the right way to think about it now. Not as a fixed formula, but as a yearly decision. The need to review the tax band position is especially important because the official dividend rates vary sharply by band in 2026 to 2027. So, is the old director pay strategy still worth it in 2026? The honest answer is yes for some people, but not automatically for everyone. The rise in dividend tax rates and the tiny £500 allowance mean the old salary plus dividend model is no longer as powerful as it once was. That does not mean dividends stop mattering. It means the planning has to be more careful, more personal, and more current. In the next video, we will move to a different 2026 issue that catches many property sellers out: the 60-day reporting rule for property gains. Thanks for watching. Subscribe to SelfTax for clear, practical UK tax guidance. Stay informed, stay compliant, and stay one step ahead of HMRC.